Chapter.
Morning.
Yeah, it's sir. Please, sir. A very warm greeting to one and all who are gathered over this virtual base to join this particular morning session on cost and management accounting. This is Nitish Kannan, a CA final student who will be hosting throughout this session. And we have CA Z Shanti Ganapati ma'am to host this to guide us through guide us in this particular session on cost and management accounting. For the benefit of the students, we'll have a brief introduction about her profile, so that students could also enrich from the knowledge which she possesses. So to start with their educational qualification, she is a very apart from CA, she is also a cost and management accountant. And to note, she is also a CA intermediate. She also managed to secure all India 25th rank in her CA intermediate examination. She has completed all She has also completed a PG diploma in financial management, that is postgraduate diploma in financial management, and she has also secured. She has also accomplished advanced diploma in management accounting. Currently, she is a visiting faculty at SIRC of ICAI Chennai and Grey Matters Academy. Also, she has been a visiting faculty of various branches of ICAI, such as Madurai, Kollam, Kozhikode, Thrissur, Bangalore, to mention a few. Her areas of excellence include strategic management, cost management, strategic financial management, cost accounting, and strategic cost management. Also, she is apart from ICA, she had also been a visiting faculty of ICMA, ICFA, and Stella Maris College. So to note, she was a resource person in the faculty development program organized by ICA, program for BSNL executives and central excise executives organized by ICA. Once again, I would extend a very warm welcome to CA Shanti Ganapati ma'am to guide us through this particular session. Ma'am, the virtual stage is yours.
Thank you for the kind introduction. So good morning to one and all. Shall we just start the session? So let's have a session, 3-hour session to cover the entire subject. What is it we plan for these 3 hours? Let's see. First, of course, the question paper pattern, then how to manage time during the exam, then your syllabus, the problem chapters, the theory chapter, then revision of problem chapters. Being a 3-hour session, I'm sure you realize that we have to go at a rapid speed, but at the same time, we will not sacrifice the clarity because of the speed with which we have to go. Since it's a revision of the concepts, we will not be able to solve any problems because we have to cover the entire subject in what you have in 15 chapters, we have to cover in 3 hours. It will not be possible for us to solve any problem, but at the same time, I will guide you as to how to present your answer. Now, always remember this. The problem starts in a problem paper if we give importance to computation and neglect concepts. So, conceptual clarity first, analytical ability next, and then comes your computational capability. Let's first start with question paper pattern. Question 1 is compulsory, of course. You have 4 subdivisions, A, B, C, D. All 4 are problems. They carry 5 marks each. So that makes it 20 marks. This is a compulsory question. Then questions 2 to 5. You have a couple of questions where you have 2 subdivisions carrying 10 marks each. The others are 10 plus 5 plus 5. So 3 subdivisions are there. So totally questions 2 to 5, 4 questions, each one carries 20 marks, 80 marks. Then question 6 is a fully theory question where you are expected to answer 4 out of 5. So that makes it 5 sub-questions there, each one carrying 5 marks. So 25 marks. The whole paper is for 125 marks. As we have already seen, question 1 is compulsory. You have to answer 4 from balance 5. Altogether, if we see the number of problems, you have 9 problems of 5 marks each, 5 problems of 10 marks each. Totally, out of 125 marks, 95 marks is problems, which includes 20 marks compulsory and 30 marks theory. So predominantly, it is an all in all, you can say it is a problem paper. But even if you want to avoid the theory, the last question, you would be compelled to answer for 5 marks theory question. This is the question paper pattern. How do we manage time during the exam? So I'm not going to talk only about the 3 hours when you'll be writing the exam. We will also talk about the 15 minutes reading time, what you can do. During the 15 minutes reading time, don't read the compulsory question. Compulsory question, anyway you have to attend. You don't have a choice. So what is it you are going to do reading that question during the reading time? Nothing. And invariably you will find that the compulsory question is of a higher standard. And even though only 5 marks are given for each of those subdivisions, actually, you may have to spend an equal amount of time solving those problems, even as a 10 marks problem. Therefore, we will unnecessarily get unsettled if we read the compulsory question during reading time. I would advise you not to spend time reading the compulsory question during the reading time. So what do? Read the other questions. You read the other questions and decide which is the question you have to leave in choice. Then, once you have decided that, you also know when you have read the other question, you would have decided which is the question that you are going to leave in choice. If you decide it's a theory question, fine. Otherwise, if you decide it's one of the problem areas where you are not very sure, that also is fine. In the first 1 hour, answer the 2 questions for which you can solve and get the entire marks. You will know out of the 4 questions which you have selected to answer, you will have 2 questions about which you are very sure. Therefore, answer those 2 questions first. So in the first 1 hour, you would have pocketed the minimum guarantee of 40 marks. Then the next 45 minutes to 1 hour can be spent on the compulsory question. I already told you, even though compulsory question, you have 4 questions of 5 marks each. It is not that you will take only half the time of what you take for a 10 marks question. Sometimes you may take an equal amount of time. Therefore, 45 minutes to 1 hour you can keep for the compulsory question to answer the 4 subdivisions, all being problems. And then the last 1 hour, you answer the other 2 questions. You can plan your exam time and manage it this way to make it more efficient and effective. Then, which are all the problem chapters? The problem chapters which we have, I have grouped them. First is where we give importance to the cost elements, namely chapters 2, 3, 4, and 5. This forms one group where you talk about material, employee cost, and overheads. So this is one group. Then you have 3 chapters where they are similar. They have to be grouped together, where you give importance to the functional classification and the flow in which you have the production, that is given importance, namely Chapter 6 cost sheet, Chapter 7 cost accounting system, and one part of Chapter 8, which is unit costing. Then, when we come to the methods of cost accounting, you can classify them into two groups. Specific order costing methods, you have the second part of your Chapter 8 batch costing. Then you have Chapter 9 job costing and contract costing. Then you also have 3 chapters on continuous operation costing methods, process costing, joint products and byproducts, and service costing. Then, of course, you know your paper is cost and management accounting. We come to the management accounting area, which is standard costing, marginal costing, and budgetary control. We will come to that area. Theory chapter, the loan all theory chapter is your first chapter. As with any subject, you know that the first chapter will be an introduction chapter, will be an all theory chapter, even in a theory subject. Introduction to CMA. Your theory questions, totally, we saw you will have 6 theory questions. You will find that invariably 2 to 3 questions come from this chapter, and the other 3 questions comes from any of the other chapters. Now, what should you do for revision? Last minute revision, what should you do? We will have a thorough revision of concepts today in the 3 hours time which we have. You will solve 2 RTPs, May 22 and November 22, 2 MTPs, Series 1 and Series 2, your September 22 and October 22, and suggested answers, January 21 and July 21. When you do this, you would have exhaustively covered everything. So this is what you should do in your last minute revision. Is that fine? So when I say revise these, you should not look at the question, look at the answer and say, okay, this is what they have done, that's fine. See, everything will be fine when we see the answer. You should ensure that you look at the question only and then you solve on your own. So shall we get into it? The idea is in the 3 hours which we have, I will spend the first 1 hour or so on the cost element part, that is material, employee cost, overheads, and activity-based costing revision. And then the next 1 hour or so I would spend on the methods of cost accounting. And the last 1 hour I will spend on management accounting, our techniques of costing, namely standard costing, marginal costing, and budgetary control. I think if we do this, we will be able to do justice in the 3 hours which we have. I think you are okay with this plan. And on the assumption that you are okay with this plan, I go ahead with this plan. The first one we are looking at is Chapter 2, Materials. In Chapter 2, Materials, you have mainly 2 things. 1, EOQ, and 2, your stock levels. It is predominantly a formula-based application of formula type thing. And so you can actually revise it pretty fast. EOQ formula, all of you would know, so I'm not displaying that. Square root of 2b CO by CC. Of course, different symbols could be used. D stands for the annual requirement which you will have for that raw material. And then CO is, of course, ordering cost per order. And CC is the carrying cost per unit per annum. Since in the numerator, we took annual demand, in the denominator, we will take carrying cost per unit per annum. Here, just one word of caution. You need to ensure that you are finding EOQ for the raw material. Sometimes what they will do, they will give the demand for the finished product and say the requirement of raw material for the finished product. You should be careful in taking. Since we are ascertaining the economic order quantity for the raw material, you should ensure that what you take as annual demand is for the raw material and not for the finished product. And after that, you have the various stock levels. So you have the reorder level. Reorder level, the basic idea is you should have enough before the stock reaches you after you order. So whatever is the maximum lead time consumption, if you have that as the reorder level, you will never run out of stock. Then maximum level is the level which you will normally not exceed. So that will be the reorder level, at which point of time you place the order. And during lead time you would have consumed, you are ascertaining the maximum level. So the lead time consumption has to be the minimum. And once that is done, you will get the reorder quantity. So that will be the maximum level. Minimum level is normally what will be the minimum level, below which the stock will not go. So that will be reorder level minus the normal lead time consumption. Average level, as always, will be maximum plus minimum by 2. And your danger level is when you have to initiate emergency action. So emergency lead time consumption, that is normal usage into emergency lead time. This will be the base for the stock levels. And let us just move on to employee cost. In employee cost, you might have 3 types of problems. The first type of problem is where you have some premium bonus plan, namely Halsey and Rowan. They will ask questions on that. So what is it you will have in Halsey and Rowan? They are premium bonus plan. That is, you are guaranteed the time wages and you are given a premium, a bonus for your efficiency. There are 2 basic systems. 1, the time. 2, the piece rate. Time rate is basically based on the time you spend, you will be remunerated. Piece rate based on how much output you have generated, you will be remunerated. So these are the 2 basic plans. And coming to Halsey and Rowan, Halsey, again, as I told you, both Halsey and Rowan, they guarantee time wages. So hours worked into time rate will be there. Then based on efficiency, you will be compensated. Under Halsey, see, if the worker is efficient, what happens? He is able to save time. His efficiency is about being able to do it faster. So he is able to save time. The time saved benefit under Halsey will go, half of it will go to the employer and half of it will go to the employee. So the employer, in addition to the time wages, will compensate the worker for 50% of the time saved at the time rate. Normally, it is 50%. In case they mention 40%, or you have an Halsey where it is 1/3, then you go by the question. Nothing is mentioned, it is 50%, 50-50, 50 for the employer and 50 for the employee. Then come to Rowan. Under Rowan, you look at what is the hours worked into time. Again, time wages is guaranteed. Then the more time you save, that much of your time wages is given to you as a bonus. So you take time wages and then a proportion of time wages. What proportion? The proportion time saved to time allowed is there. You will be compensated. That is Rowan. Time saved, of course, is time allowed minus time taken. You may be asked to find the effective wage rate per hour. The effective wage rate per hour would be whatever is the wages paid divided by the hours worked. So this is the first type of problem which you will have in employee cost. The next type of problem which you will have is, instead of adopting one of these standard plans, the question itself will mention what is the plan, how much bonus they are planning to give, what is the increase in efficiency that is looked. So that they will give, and you go by the question. For this, you need not have any planned plan or anything. Whatever they give in the question, accordingly you have to do. Then, of course, you have labor turnover problems. Labor turnover, mostly the first category of problems, Halsey Rowan only will come. And next in importance is this, where the question itself mentions what is the plan. And lastly, you have the labor turnover plan. Labor turnover, you have different methods. Labor turnover is the change or the rate of change in the composition of workforce. So rate of change, you could take replacement, you could take separations, you could take accessions, or you could take both replacement and separation. Anything of this could be the numerator, and the denominator would be average number of workers. And you want to establish as a percentage, you will multiply with 100. So that's all for employee cost. Then next, we come to overheads. Now, materials and employee cost, you would have done many problems. Always this happens in any subject. The first 1 or 2 chapters you would have done over and over again. And also they will be easy chapters. So I didn't spend much time on materials and employee costs. We had a quick revision. Now come to overheads. Normally, most of the students do not like the chapter overheads. They'll say overhead. Ma'am, overhead is over our heads. They don't like. I do not know how you like it or not. But let me tell you, overhead cost accounting is the crux of cost accounting. Because what is overhead? Overhead is the aggregate of indirect material, indirect labor, and indirect expense. Now, based on traceability, cost can be classified on many bases. Based on traceability, you can classify it as direct cost and indirect cost. Direct cost means directly you can trace to the cost object. So what is a big thing in finding the cost? Ascertainment of cost is not difficult. But indirect cost that cannot be traced, still you are able to bring it into the cost unit of the cost object. That is what is challenging, and that is what is the crux of cost accounting. Now, there are 3 terms about which you have to be absolutely sure if you have to appreciate the subject of cost accounting and understand it well. What are those 3 terms? Cost object, cost unit, and cost center. Cost object is anything for which a separate measurement of cost is desired or required or undertaken. I want to find the cost of something. That something becomes the cost object. Now, if I am a manufacturing company producing consumer products, what can be considered as a cost object? Let us say I am manufacturing body wash, soap, talcum powder, face cream. These are the consumer products I am manufacturing. Then I might be interested in ascertaining the cost of each of these. So each one of these will become my cost object. Then what is cost unit? Cost unit is a quantitative unit of product, service, or time. A quantitative unit of product, service, or time, or a combination of these, in relation to which cost may be ascertained or expressed. So cost unit is a unit of physical measurement, very important, physical measurement of output. Now, input also will be measured in some unit. Output also might be measured in the same unit or some other unit. But what we mean by cost unit is only the physical measurement of output. Then there is yet another term. I was telling you in the beginning itself, there are 3 terms about which you have to be absolutely sure: cost object, cost unit, and cost center. What is a cost center? Cost center can be production location, service location, function, activity, item of equipment, person, or a group of these. It can be a production location. It can be a machine shop, assembly shop, something. Service location, stores, purchase department, like that. Function, administration. Activity, inspection. Item of equipment, lathe machine. Person, manager, supervisor, something. So my call center can be a production location, a service location, function, activity, item of equipment, person, or a group of these, for which cost may be ascertained. Cost center is something for which I find out the cost. What purpose? I have twin purposes. I will ascertain the cost for a cost center and use it for the purpose of 1, relating cost to cost unit of cost objects. So if this is my idea, I will have production departments, I'll have service departments. What is the idea of having these cost centers? I want to relate the cost to cost units of cost objects. Okay, there is yet another purpose or objective. What is it? Cost control. If cost control is my idea, I can classify cost centers into 2 things: standard cost center and discretionary cost center. Then, apart from this, there are again 3 things which we should know. Of course, we have already seen overhead cost is cost on material, labor, and service, which cannot be economically identified. Identified with what? A specific saleable cost unit of a cost object. We know that it's the aggregate of indirect material, indirect labor, and indirect expense. Now there are 3 more terms which we should know: cost allocation, cost apportionment, and cost absorption. You will find that in many places, allocation and apportionment are used interchangeably, but they are not the same, they are different. What is cost allocation? Cost allocation is the charging of discrete identifiable items of cost to cost centers. So it refers to allotment of a whole item of cost to a cost center. What is cost apportionment? Cost apportionment is the division of cost among 2 or more cost centers in proportion to the estimated benefit derived. When I say it is in proportion to the estimated benefit derived, I am not trying to divide the cost equal. I am trying to divide the cost equitably based on the estimated benefit. After cost allocation and cost apportionment, the overhead costs have to be assigned to the various production and service cost centers. What is a production cost center? A production cost center or a production department is where the actual manufacturing takes place. What is a service cost center or a service department? Production does not take place in a service department or a service cost center, but service departments are essential for the smooth functioning of production departments. Example, purchase department, stores department, repairs and maintenance department. Actual production doesn't take place in any of these places, but they are required for the smooth functioning. Then after cost allocation and cost apportionment, we have what is known as cost absorption. What is cost absorption? My idea is to have the cost in the cost unit of the cost object. Why? Because that is what I am selling. The objectives of cost accounting you would have learned is ascertainment of cost, determination of selling price, ascertainment of profit, and providing cost information for cost control, cost reduction, and decision making. You would have learned this as the objective in the first one. So my objective is to find the cost for the cost unit of the cost object, because that is what I am selling and getting my revenue. So I'll be able to ascertain the profit only if I have the revenue and the cost for the same thing. Just give me a minute. So that is the reason why we have cost unit as a quantitative unit of measurement for the cost object, which is our output. So this is overheads. Overheads you can deal with in 3 ways. The first one is what is known as blanket overhead rate. The name itself tells you, you have one single overhead rate for the entire factory. When is it suitable means only one product is manufactured, or very few products are manufactured, all products pass through all departments and all products use the resources of the various departments in a similar manner. Then how do you find the blanket overhead rate? You take the overhead for the entire factory, divide by the total number of units which you have produced. But as we have seen, it is not suitable under all situations. You should be manufacturing a single product or very few products which use the resources in a similar manner. So an improvement over this would be departmental overhead rate, where you have a primary distribution. When you distribute the various items of overhead cost among the various production and service departments. But as we already seen, the production department is where the production takes place. No production takes place in the service department. So the service department costs also have to be again redistributed to the production department, which is known as secondary distribution. Now, there are various methods by which we can do secondary distribution. When there is no inter-service department service or it is ignored, we will do a direct redistribution method. Under this method, the service department costs are distributed over production departments only. Then we have, when we have non-reciprocal service, we can use step ladder method. Now this is variously known as step method, ladder method, step ladder method, non-reciprocal method. So this method, unlike the direct redistribution method, recognizes services rendered by one service department to another. The service department that renders maximum service to other service departments is taken first. The cost of this service department is distributed to production departments and other service departments. Next, the service department that renders the next highest service is chosen. And again, the cost of this service department is distributed to production departments and service departments other than the first. So this process you keep repeating until the cost of the last service department is distributed only among the production departments. You also have reciprocal service, for which you will have three methods which you can use. First one is repeated distribution method, then trial and error method, and lastly, simultaneous equation method. Under repeated distribution, you'll take the cost of the first service department, distribute to production departments and other service department. Then second, you will distribute to production departments and other service departments, including the first. Like this, you will go on because you are again and again distributing, repeatedly distributing. You will get, even though you have distributed for a service department, the cost of that service department, again, because of a repeated distribution, you will have some more overheads, which you will distribute. You will go on like this till the amount becomes negligible. Then you have two other methods, trial and error method and simultaneous equation method. Under trial and error method, secondary distribution is done in two stages. The first stage is similar to repeated distribution method, the difference being under trial and error method, service department costs are repeatedly distributed only among other service departments. So again, the process is repeated till the amounts becomes negligible. After the first stage, the service department cost includes cost of services received from other service department also. And in the second stage, the service department costs are distributed only to production department. Then you have simultaneous equation method. Under this method, secondary distribution is done again in two stages like trial and error. In the first stage, algebraic equations are framed and solved to find the cost of service departments, including inter-service department service. And then in the second stage, like the trial and error method, the service department costs are redistributed to production departments only. There are a few points which we should remember when we do this. The direct costs of production departments should not be included in overhead distribution because it is direct and can be traced to the cost object. Overhead itself is what is indirect, is what we will take. Then the second point which you have to note is direct costs of service departments should be included in overhead distribution because it is directly traced to the service department, not to the cost object. Then indirect cost of both production and service department should be included because that is not traceable to the cost object. The key of what is to be included and what is not to be included is it traceable to the cost object? That is what we have to see. Then you will have various bases of apportionment which you will use. You have, supposing you do not want a separate classification for certain items, you will club them under general or sundry or miscellaneous or other overhead. That is to be apportioned or distributed on the basis of direct labor hours or direct wages if the production is predominantly manual. Or it can be apportioned on the basis of machine hours if production is mechanized or automated. So this is your departmental overhead rate. Once you have all the overhead cost in the production department, you will have a basis of absorption for each production department. You will take the overhead of the production department, divide by the number of units of the absorption base to find the rate. Let us say labor hours is what you have used. So this direct labor hour rate has to be applied on the number of hours spent on cost object in that production department. Supposing let us say we are talking about job, and the job takes 4 hours in production department 1, and the rate is 20, you will say 4 hours into 20. And in the second department, if it spends 2 hours and 50 is the rate you have found, you will do 2 hours into 50. Like this, you will find the overhead rate. Now, because of its importance, separately, you will have what is known as machine hour rate. You will be asked questions only on machine hour rate. Now, machine hour rate, you may ascertain for one machine or a group of machines, which is known as machine shop. So how will you find the machine hour rate? The overheads of a machine or a machine shop for a period should be taken. Then the productive machine hours for that machine or machine shop for the same period should be taken. I would like to stress this point. Some items of overhead could be given for 6 months. Some could be given for 1 year. Some could be given for 1 month. You should first decide whether you are going to take 1 month or 6 months or 1 year. And accordingly, the productive machine hours also you should take for the same period. You cannot have the overhead for a particular period and the activity for another period. The numerator and denominator, you have to maintain the overhead cost and the activity level for the same period. Now, productive machine hours means what? Machine hours which are considered for computing machine hour rate. Then you will have something called running hours. What do you mean by running hours? Machine hours when actual production takes place, that is running hours. Running hours are always productive. Then you have setup hours. Setup hours are hours spent in setting up the machine according to production specifications as per the production order. Setup is required before every production run. Setup hours can either be productive or unproductive. Then maintenance hours spent in preventive maintenance. So maintenance hours are unproductive. Repair hours spent in repairing the machine when it breaks down. Repair hours are unproductive. Now, power, if there is no information in the problem, you should assume power is not consumed for setup or machine, for setting up of the machine or maintenance of the machine. Estimated lifetime hours, if it is given, it is based on actual productive running hours. That is when production takes place. So this is the next category of problem which you will have in overheads. Then lastly, you might have based on under absorption or over absorption. So you will have, when we talk about overhead absorption rates, you can have 2 situations. One, actual overhead absorption rate. 2, predetermined overhead absorption rate. What do you mean by actual overhead absorption rate and predetermined overhead absorption rate? Yes. What is it we are discussing? When you talk about overhead absorption rate, you could have actual overhead absorption rate or predetermined overhead absorption rate. What do you mean by actual overhead absorption rate? The actual overhead cost incurred in a production cost center for a period will be taken, and actual activity undertaken in that production cost center for the same period will be considered. What is the advantage? The advantage is that it is the actual cost. Therefore, you do not have the question of under-absorption or over-absorption. But then you have a couple of disadvantages for actual overhead absorption rate. What are they? Cost will be available only after the period. The fluctuating costs and activity levels between the periods will cause the rate also to fluctuate. And the rate will not be uniform, and this would lead to cost distortions. So I can't use it for control and decision making. This is the problem I have. Therefore, I have predetermined overhead absorption rate. Predetermined overhead absorption rate, how do I find? I take the budgeted overhead cost estimated for a production cost center for the forthcoming year. I consider the budgeted activity level in that production cost center for the same year. Budgeted overhead cost, of course, would be estimated before the period. Budgeted activity level also is estimated before the period. The advantage is that the two disadvantages which I had for actual overhead rate, namely cost will be available only after the period is not there. Cost is available even before. And the other one, that the rate will keep fluctuating because of fluctuating activity level and cost is also not there because I've taken the entire year. So these two problems I have overcome. But then I have a disadvantage in that since it's predetermined, it will lead to under or over absorption. Therefore, what should I do with the under or over absorption? I have to consider. What should I do? The actual overhead, what is overhead absorbed? Overhead charged, overhead applied, overhead recovered, everything means the same. Absorbed, charged, applied, recovered. So I take the predetermined overhead absorption rate and multiply with the actual activity during the period. This will be the overhead absorbed. Actual overhead is fully actual. Predetermined rate, both cost and activity level are budgeted, predetermined. Whereas overhead absorbed is a hybrid. You take the predetermined rate and apply it to the actual activity. So what should I do? I should compare the overhead absorbed, which is actual activity into predetermined rate, with the actual overhead. I have to find the actual production overhead incurred in a production cost center by taking the actual overhead paid, adjusting for non-production cost, adjusting for prior period and subsequent period cost, and then find the overhead incurred. The difference is under absorption or over absorption. Difference between overhead absorbed and actual overhead. In case of under absorption, overhead absorbed will be less. In case of over absorption, overhead absorbed will be more than actual overhead. Then how I treat that depends on what is the cost. If the under or over absorption is because of abnormal reasons, I should transfer to costing P&L. If the amount is significant, I should consider it differently if it is not abnormal and the amount is significant. But if the amount is insignificant, again, I can transfer to costing P&L. When will I use a supplementary rate means when it is because of wrong estimation and the amount is substantial. So transfer to costing profit and loss account happens either because it is due to abnormal reasons or because the amount is insignificant. Either or. One is satisfied also. This is what we will do. Now, when will I use a supplementary overhead rate? When it is due to wrong estimation and both have to be satisfied. When it is due to wrong estimation and the amount is substantial. Supplementary overhead rate will be under or overhead absorbed divided by the activity level. Here again, I'll have to look for the units produced, has it been sold? If so, I will transfer the under or over absorbed overhead to cost of sales. If it is not sold, I will transfer to finished stock. If I have work in progress, I will transfer to work in progress. So we have completed revising this chapter, namely overheads. So chapter 2 materials, chapter 3 employee cost, and chapter 4 overheads we have revised. We are left with activity-based costing. In activity-based costing, we will look at, see, activity-based costing is an improvement over departmental overhead rate. Departmental overhead rate was an improvement over blanket overhead rate. In activity-based costing, we can look at it based on the type of organization. Manufacturing organization. Manufacturing organization, how will I go about it? In manufacturing organizations, I can look at distributing overhead in 2 stages. The first stage, the overhead costs are pooled based on activities which have consumed resources. The second stage, a link is established between the activity cost pool and the cost object. So, manufacturing organization, what are the steps involved? If you systematically approach, then there should be no problem in solving the problem. Activity-based costing is a sheer problem. See, in fact, all that we have done, chapter 2 materials, chapter 3 employee costs, chapter 4 overheads, whatever we have revised in every chapter, you will get a question. Similarly, activity-based costing also, what we are doing now, chapter 5 is important, and it helps to have a systematic approach to solving the problem. What are the steps involved in solving the problem? First, identify the various primary and support activities in an organization. What do I mean by primary activities? Activities that are directly involved in transforming inputs into outputs. Then, once production is done, what will you do? Delivery. After delivery, will you forget about the customer? No, after sales support. So, primary activity means all activities that are directly involved in one of these, in production or delivery or support. Support activities are activities which support the primary activities. Then the second step would be to create a cost pool or a cost bucket for each activity. All this means is collect the overhead. Then I will identify a cost driver for each activity. This is similar to the absorption base. Supposing it is not possible, then I have to spread the cost of that support activity across other activities. This is like a secondary distribution in departmental overhead rate. I'll give you a couple of minutes for you to take in this, then we will go to the next step. Okay, are you through with this? The first 4 steps? First one, identify the various primary and support activities. Second, create a cost pool or a cost bucket for each activity. Then identify the cost driver for each activity. Then when it is not possible, you will spread. The fourth step, mostly you won't have. You will be able to identify a cost driver. Then we will find the activity cost driver rate. That is total cost. This is basically the rate at which you are going to absorb. Instead of saying absorption rate, it is known as cost driver rate. Cost driver is that factor which is a significant determinant of cost in that activity. If this factor goes up, cost also goes up. If this factor comes down, cost also comes down. So it's similar to absorption base. Then you will use the cost driver rate to relate the cost of activities to products using cost driver rate. Then you will find the overhead cost for each product. How will you do that? Now you have activity-wise overhead cost for every cost object. You will add it to get the total overhead cost for each product. Is this clear? Now, this gives you the total overhead cost. You might be interested in the overhead cost per unit. Therefore, divide by the total number of units. Are you clear with this? See, organizations can be only one of the 3 types. They can be manufacturing organizations, or they can be trading organizations, or they can be service organizations. This is what we have for manufacturing organizations. Systematically, stepwise you do. You will have no difficulty. Now, as I was telling you, how to present the answer. Presentation is definitely important, you know that. So how will we present the answer? Means, now sometimes in your exam, they ask for cost driver rate separately. When they ask for cost driver rate separately, you will have to accordingly give that. And it is always better you give the cost driver rate separately. Now let me just tell you how you can present your answer like this. You can have the various activities listed. Then you can have the cost for each activity. Then you would have identified the cost driver. Then the number of units of the cost driver, you'll get the cost driver rate. And once you have the cost driver rate, you will multiply with the units for each cost object. In this problem, A, B, C, D, those are your cost objects. And when you add the activity-wise cost for each cost object, you get the total cost, divide by the number of units, you get the overhead cost per unit under ABC for every product. So you can plan to have your presentation like this. Presentation is important. Not only will it impress the valuer, for you also, if you present nicely, you will have the clarity as to what you're doing, and it will also help you to get the confidence. So we have completed this chapter also. Now, with regard to service, the only difference is in service organization, the cost object changes. Instead of the product, it will be the service. Next, let us move on to trading organizations. In trading organizations, again, you could have three ways of doing it. First is when you rank the products based on gross margin. We will find the gross margin product wise. We will take the total gross margin and we will find the total operating profit. Gross margin, of course, is revenue minus cost of goods sold. Now, this is not a proper basis for ranking because you are considering only direct cost of goods sold. You are not considering the support cost. Then you have the second method where you will find the gross margin product wise. You will find the support cost as a percentage of cost of goods sold. You will assign the support cost to the products based on this percentage, and you will find the operating profit product wise. Then lastly, of course, you will find the gross margin, but you will assign the support cost using ABC. Operating profit, you can find product wise. Of course, whatever you do using ABC is the best method. So three methods are there. Let me quickly display the three methods for you. So what is the first step? We will find gross margin product wise, then revenue for each product minus cost of goods sold for that product. Total gross margin we will find. We will find total operating profit. We are finding gross margin only and using it for ranking, and support cost is not assigned to every product. It is given only in total. This is done. Next, let us look at the next method. What is the next method? The ranking will be based on operating profit, but support cost will be a percentage of cost of goods sold. So gross margin product wise, you will find support cost as a percentage of cost of goods sold. You will assign support cost to products. Operating profit, you will find product wise. Then, of course, method 3, ranking based on operating profit using ABC. Under this method, support cost is assigned to products using ABC. You will find gross margin product wise. You will assign support cost using ABC. You will find the operating profit product wise. Of course, this method is most appropriate. Why? Because under ABC, resources are assigned to activities to cost objects. So resource consumption is considered to assign the cost, and therefore this method is most appropriate. So As I was telling you, the first 1 hour or so, I told you we will be spending on the first block of our chapters, which is based on cost elements, namely Chapter 2 materials, Chapter 3 employee costs, Chapter 4 overheads, and Chapter 5 activity-based costing. Now, the next category, namely what you have under cost sheet, then cost book, and then unit costing. In this cost sheet, we will revise. And integrated and non-integrated, I'm sure you would have done enough. So I will take the liberty of skipping it. So next, let us look at cost sheet. Now, once you know cost sheet, you know unit costing also. It also follows the same thing. So how do you prepare a cost sheet? As I told you, when you talk about cost sheet, when you talk about cost accounting systems, when you talk about unit costing, all three I have grouped under format oriented. So you will consider opening stock of raw material, you will add purchase of material, add freight inwards, you know that forms part of material cost. If you have a scrap from raw material, you deduct it here. Closing stock you will deduct. This will give you material consumed. Employee cost you will have. Then direct expenses you will add at this stage. Whether it's royalty paid on production, higher charges for special equipment, or product specific design and drawing, product specific software. So only one product is manufactured, power cost can be easily traced. So that will also be a direct expense. So this will give you prime cost. To this you will add works cost, factory cost, manufacturing overhead, production overhead, everything means the same. So I have given a list of what all might constitute factory overhead. So you will have the gross works or factory cost. You will adjust your work in progress here because work in progress means it's not yet left the factory. So it has to be adjusted at this stage. So this will be towards completed production during the period. See, you find that logical sequence or flow is there. The first one is, see, transformation happens when the raw material is being transformed using men and machine. So you have the raw material consumed first, then you have the employee cost, then you have the factory cost, that is all relating to the infrastructure, machinery, building and all that. And then whatever has not left the factory, it's still work in progress, you adjust. And once the completed production comes, that is when you are going to check for quality. So quality control cost will be there. Any research and development which was successful and which you try to load on, that has to be adjusted here. If you have an administration overhead which is related to production, that also has to be adjusted here. Now, you have to be careful that scrap from material is adjusted here, whereas scrap which results from a process is adjusted here. So any byproduct is there that you sell, all those things will be adjusted. So once this is done, quality is checked, you are going to pack it. So primary packing, this will be cost of production. At this stage, you will adjust for finished goods, opening and closing stock. You will get cost of goods sold. Then all the non-production cost you will adjust. You will get cost of sales. Match it with sales revenue to get profit. So cost rate is thoroughly format oriented. If you know the production sequence, you will observe that the cost accounting system also follows the same sequence. You are integrated and non-integrated. The difference between integrated and non-integrated is, in non-integrated, you are going to have two sets of books. So costing, it is enough, it satisfies only your requirement towards costing. Whereas if it is an integrated book, you need to satisfy both costing and financial accounts. So under non-integrated, what do? The cost accounting system records only those transactions which relate to product manufactured or services rendered. You will not be having accounts for personal or real accounts. So to complete the double entry, you will have a cost ledger control account or general ledger adjustment account. Under integrated, it has to satisfy both. Therefore, in addition to this, what you will do, instead of general ledger or cost ledger control, you will put in the respective real account or personal account. So that is integrated. As long as you are comfortable with journal entries and you know the sequence, that shouldn't pose any difficulty. So the second block is over. Shall we move on to continuous operation costing methods? Methods of costing can be segregated into two: specific order costing methods, continuous operation costing methods. Under specific order costing methods, you have job costing, contract costing. Once you know overheads, job costing will be material cost plus labor cost plus the overhead cost. You should have no difficulty in doing it. Contract costing again is a contract account is prepared for every contract in the books of the contractor. And in the contract account, basically, the main concept with a contract account is that it spreads through more than one accounting year. And therefore, how are you going to recognize the profit? That is one. And what type of construction contract it is? That is another. You could have two types. One is your fixed price contract. The other is your cost plus contract. A fixed price contract is a construction contract in which the contractor agrees to a fixed contract price. Because it takes a long time and the price of material and labor might fluctuate during this time, you may have an escalation clause. Excuse me. Escalation clause provides for an increase in the contract price as per the terms of the contract. Then you will have a cost plus contract. A cost plus contract is a construction contract in which the contractor is reimbursed for allowable defined cost plus a profit. Now, cost plus contract, there might be a need to enter into it when it is not possible to estimate the contract cost, or when the cost of material and labor keeps fluctuating and the contract is for a very long period, or when the work to be done is not finalized at the time of entering into the contract. So cost plus contract is good in that it offers a fair price to the contractee and a reasonable profit to the contractor. Since the contractee reimburses the contractor for the expenses, obviously the contractee is empowered to examine the books and documents of the contractor. So the methods of income recognition, you have completed contract and you have percentage of completion. Completed contract is after the full contract is over, only you will recognize the profit, but this is not good because it doesn't adhere to your accrual concept. So percentage of completion contract only will be done. Under this method, based on the degree of completion, you will decide how much profit to be taken. But as far as you are concerned, you will be asked to find notional profit only. What do you mean by notional profit? Notional profit means for that period, what is the profit? Now, when you talk about profit, you have some terms with which you have to be familiar. One such as notional profit. Notional profit is whatever is the profit for the period. That will be work certified minus cost of work certified. Estimated profit will be the profit for the entire contract in respect of an incomplete contract. So estimated profit will be contract price minus estimated total cost. Estimated total cost will be cost incurred up to the current period plus cost incurred in the current period plus estimated further cost. So there are a couple of other terms which you will come across, namely progress payments or cash received. The contractor cannot wait for getting the payment till the contract is complete. Why? Because it takes a long time and huge investment is necessary. So the contractor and contractee, they will agree that a percentage of work completion as certified, which is what is work certified, by an expert would be released. So progress payments is that portion of the work certified released by the contractee, and retention money is the balance. So this is what you need to know for specific order costing. If this is fine, we can go to continuous operation costing. Under continuous operation costing methods, the first thing we are looking at is process costing. What is process costing? Process costing is a method of costing employed by companies which are engaged in the manufacture of products which pass through a series of sequential processes where the output of the first process becomes the input of the next process and so on. Wherever the processing is done, the transformation happens by undergoing many processes, then you will have process costing. Oil refinery, food processing, chemical manufacture, drug manufacture, all these employ process costing. If you have many processes, it is process costing. If you have just one process and one output, that is unit costing. Now, process costing is a method of costing whereby costs incurred during a period are charged to processes or operations and average over units produced during that period. So when I say there is an input, there is an output, there is a possibility of having a loss. The quantity, weight, or volume of the process output may be less than the quantity, weight, or volume of the material input due to evaporation or residuals, due to handling, breakage, spoilage, or withdrawal for testing and inspection. So there will be a process loss. This loss can be normal or abnormal. What is normal loss? Normal loss are unavoidable losses that are inherent in the production process. These losses occur even under efficient operating conditions. What is a treatment? Fundamental cost accounting principle. All normal costs should be charged to production. Therefore, the cost of normal process loss should be absorbed by production. It is quite possible that this normal process loss is in the form of a scrap which can be sold and could generate some revenue. So the scrap value is a normal revenue, and hence you should credit the process account with a scrap value of normal loss. Abnormal loss is loss over and above the normal loss. The cost effect of abnormal loss should be excluded from the process account. The abnormal loss unit should be valued on the same basis as good production. Any scrap value of abnormal loss represents revenue of an abnormal nature and should not be used to reduce the process cost. There has been an increase in scrap units because of abnormal loss. If these units fetch a scrap value, the abnormal loss is reduced by the amount of scrap value. Supposing nothing is mentioned in the problem, You should assume that abnormal loss units will also fetch the same scrap value as normal loss units. You could also have a situation of abnormal gain. It's possible that in a period, due to some unexpected favorable condition, actual loss was lower than expected normal loss, then you have an abnormal gain. What is the treatment? Gain or loss, no issue. Abnormal means it should be excluded from the process account. The value of abnormal gain is computed on the same basis as that of good production and taken to costing P&L. Now, cost per unit. This is something which we have to find. What is it? Cost of the process minus scrap value of normal loss divided by input in units minus normal loss in units. What is the idea? The idea is I want to find the normal cost. When I find the cost per unit, which I am going to apply on my good production, on my abnormal gain, or my abnormal loss. Cost also, I should take the normal cost. Production also, I should take the normal production. So how do I find cost per unit? Whether I have only normal loss, or normal loss and abnormal loss, or normal loss and abnormal gain, whatever be the situation, I should find cost per unit as cost of the process minus scrap value of normal loss. The numerator gives me the normal process cost divided by input in units minus normal loss in units. The denominator gives me the normal production. So I have not allowed any abnormality to distort my cost. I am taking only normal cost and I am taking only normal production. Is it clear? So the situation is pretty simple if we have only completed units. But that need not be the case, isn't it? We could have some work in progress. If we have work in progress, how do we do it? If we do not have work in progress, question is very simple. How do we solve? If we do not have work in progress, how will we solve? We will debit the process account with all the items of cost. We will credit the process with scrap value of normal loss. We will ignore abnormal loss or gain here. Then I will find abnormal loss or abnormal gain units. Then I will find cost per unit. I will apply the cost per unit to actual output. Abnormal loss or abnormal gain also, I will apply the same. Then abnormal loss units and value will be shown on the credit side, or abnormal gain units and value will be shown on the debit side. I will find the profit. I will see if I'm interested in finding the profit, I'll transfer it to income statement and find the profit. If I'm transferring it to next process, then the cost only will be taken to the next process. Only in inter-process profit, I will show the profit also in the process account. Otherwise, the process account is meant for finding the cost only. So this is when you do not have any work in progress. When you have work in progress, what do you do? When you have work in progress, the cost of a process during a period should be assigned to production in the process during that period. In case of closing work in progress, production consists of fully completed units as well as partly completed units. I cannot give the same cost per unit for completed units as well as work in progress. So what will I do? In such problems, it's always a good idea to prepare a quantity reconciliation so that if there is some missing information, I can find out the missing information. How will I do this quantity reconciliation? Input should be equal to completed production plus closing work in progress plus loss. If input is not equal to completed production plus closing work in progress plus normal loss, it means there is some abnormal loss or abnormal gain. Then I will prepare a statement showing equivalent production. What is equivalent production? Equivalent production means converting incomplete units into their equivalent complete units. How will I do it? Have one column for particulars, one column for quantity, two columns for each element of cost, which has a different degree of completion. One will be for percentage completion and one will be for equivalent units. Equivalent units is equal to number of units into percentage completion. So input material, supposing there is no other information in the problem, should be taken as 100% complete. For normal loss, equivalent units should be taken as 0. For abnormal loss, I have to add with the degree of completion. Supposing it's 60% complete, 100 units are 60% complete, I should add as 60 units. And then abnormal gain means I have to deduct. My objective is to find normal production. Then I will find cost per unit for each cost element. Cost of each cost element divided by equivalent units of that cost element. Now, how do we find cost per unit normally? Cost of the process minus scrap value of normal loss. Now, their cost of the process included material cost, labor cost, overhead cost, everything. But now each cost element I'm having separately. Therefore, from where should I deduct the scrap value? Scrap value of normal loss should be deducted from input material cost. Next comes valuation. Abnormal loss or abnormal gain and closing work in progress, I will compute by taking equivalent units from the equivalent production statement and cost per unit from the cost statement. For abnormal loss or gain, same thing. Closing work in progress, equivalent units into cost per unit. Value of completed production alone, I can simply take completed units and multiply with the total cost per unit. Then finally, I have to prepare process account. Preparing the process account is the easiest thing to do when you have work in progress, because all computation you have done and the figures are readily available. And if you open the process account, nicely it will balance. The next thing we have to look at is opening work in progress. Opening work in progress. What is this? The closing work in progress of the previous period becomes the opening work in progress of the current period. Opening work, I'll do one thing. Maybe I will tell you how to present it. I will show a sample of an answer for you to get an idea as to how to go about presenting the answer. So let us say we are looking at a problem where, see here, statement showing equivalent production. You'll have one column for particulars, one column for quantity, and one column each for each element which has a different degree of completion, which you will further divide into two, one for percentage completion and one for equivalent units. So your equivalent production statement, you can present like this. One column for particulars, one column for quantity, two columns for each element of cost, which has a different degree of completion. Input material and direct material has the same degree of completion, means you can club. Labor and overheads has the same degree of completion, means you can club. So you could do like this. So completed production will all be 100%. Closing work in progress. For input material, it is 100%, whereas for labor, it is 50%, for overhead, it's 40%. Normal loss, we have already seen, you won't take anything, so 0%. Abnormal loss, whatever is the degree of completion given, that we have taken. So you add, you will get the equivalent units. Then you can take the cost, as I've already told you, scrap value has to be deducted from the input material. Take the cost of each cost element, divide by the number of units to get it. And then valuation. Closing work in progress and abnormal loss alone, you will take the equivalent units, multiply with the cost per unit and add. For finished goods, since it's 100% complete, you could simply take the total number of units and multiply with the total cost. Are you clear? Equivalent production statement, cost per unit, valuation. And then process account is a straightforward thing, simple affair. All you have to do, whatever is given in the problem, put it on the debit side. Whatever you have computed, put it on the credit side. Of course, if it's abnormal gain, we'll put it on the other side. It will just automatically, nicely balance. Preparing the process account is the easiest thing to do. And that is why mostly they may not ask you to prepare the process account. They may just ask you to prepare the equivalent production statement. And then they might simply ask you for the valuation. So this is how you prepare the process account. Input material, additional material, direct labor, overheads. It was given in the problem itself, this information. And then normal loss, you will credit the process. Then abnormal loss, finished goods and closing work in progress, for which you found the value. You will put it on the credit side, you will add. Of course, had it been abnormal gain, you would have put it on this side. Is this clear? So let me just stop sharing this. Now, are you comfortable? Are you clear with what we have done? Can we move on to opening work in progress? Whatever is the closing work in progress in a period will become the opening work in progress in the next period. Isn't it? So the closing work in progress of the previous period has become the opening work in progress in this period. The closing work in progress in this period will become the opening work in progress in the next period. It poses an additional challenge when you have opening work in progress, because there is a production and a cost brought from a previous period. Then how will you treat this production and cost? What is the inventory valuation method you are following? Is it weighted average cost or is it first in, first out? We will prepare a quantitative reconciliation to find out whether there is some missing information. And once that is done and you observe that there is some missing information or something, then based on whether it is weighted average cost method or it is first in, first out, the treatment will differ. So let us see what are all the steps involved. So as I have discussed with you, you will have the quantity reconciliation. that is opening work in progress units plus units introduced, should be equal to completed production plus closing work in progress plus normal loss. If not, you have abnormal loss or abnormal gain. Then, if it is weighted average cost method, what will you do in the equivalent production statement? In the equivalent production statement, the production done in the previous period in respect of opening work in progress is also included because I am not specifically excluding it. Hence, production statement will contain current production as well as production done in the previous period in respect of opening work in progress. So, in the cost statement, I should aggregate the opening work in progress cost and the current cost. Then this should be divided by the equivalent units. Valuation, again, same cost per unit will be applied to completed production, closing work in progress, abnormal loss or abnormal gain. Once this is done, I can prepare the process account. So, when I follow weighted average, in the equivalent production statement, I will not see whether the production was done in this period or previous period. I won't exclude it specifically. Whatever is the completed production, I will take. Whatever is the closing work in progress, I will take. Whether it was done in this period or previous period, I will see. So cost also, I will include opening work in progress cost as well as current cost. Now, if it is first in, first out, what will I do? First in, first out, I can maintain the identity. Therefore, in the equivalent production statement, in respect of opening work in progress, only production done in the current period I will consider. Production done in the previous period in respect of opening work in progress, I will specifically exclude. Supposing in the opening work in progress, labor is 60% complete. In the equivalent production statement, I will take only 40%. So my equivalent production statement has only current production. So when I take the cost also, I should take only the current cost and divide by the equivalent units. Then when it comes to valuation, I will consider units completed and transferred. I have two things. One is opening work in progress completed and transferred. Next, new units introduced, completed and transferred. For opening work in progress, partly the work was done in the previous period and partly it was done in the current period. Therefore, cost incurred in the prior period in respect of production done in the previous period and cost incurred in the current period in respect of production done in the current period, both will be considered. For new units, I will simply take the current cost. Then I will prepare the process account. You might have a doubt. Should I choose weighted average or first in, first out? If the problem specifically requires or there is an indication, then I will take first in, first out or weighted average, whatever the problem says. Supposing the problem has only element-wise percentage completion, then I will use first in, first out. Element-wise percentage completion is not there, but element-wise cost is there. Then I will take weighted average. Both element-wise completion also is there. Cost also is there. Then you can choose. You can decide whether you want to follow first in, first out or weighted average. So, what is it we have done? We have done the group where you had the cost elements, namely Chapter 2 materials, Chapter 3 employee cost, Chapter 4 overheads, and Chapter 5 activity-based costing. Then the format-oriented cost sheet we revised fully, and cost accounting system, I just gave you an idea as to what to do. Contract again, I just gave you an idea of what to do. And in continuous operation costing method, where you have process, joint products, by products and services, process costing we have done. We are left with joint products, byproducts, service costing in this. Then we are left with the three techniques, that is the management accounting topics of standard costing, marginal costing, and budgetary control. So we will have a short break now, then we will continue. So shall we continue with the next chapter? What is the next chapter we are interested? We are interested in joint products, byproducts. Now in joint products, byproducts, we have two types of problems. The first one is apportionment of joint cost. And the second one is taking a decision whether or not you want to further process. So first, apportionment of joint cost. What should we do with apportionment of joint cost? There are various methods which we have for apportionment. And each method, of course, will give a different answer. The various methods which we have, each one will give a different answer. Which method should we follow? The problem will indicate which method we have to follow. What are the various methods? The first method which we have is physical units, or what is called average unit cost. So how many ever units you have produced, that you can use. Now, joint products are products which have economic importance. All joint products emerge from the same joint production process. And therefore, we should look at what is the economic value. We have to look at whether economic value is there. That is the criteria for a joint product. Economic value means what? Whatever sales value it can get. At which stage? At the split off stage. What is the split off stage? Split off stage is the stage at which the products are separately identifiable. Therefore, we can look at what is the sales value at split off. Now, supposing you do not have a ready market at split off, you further process and sell. You could take sales value after further processing also. And if you take sales value after further processing, the value addition that has happened after split off is also included. You can remove it and take net realizable value at split off, which is sales value after further processing minus further processing cost minus selling expenses. And you can remove the profit aspect also and take estimated cost. So whichever method you follow, what is it you will take as joint cost? I will take total joint cost. I will multiply with the value as per method for that joint product, divide by value as per method for all joint products. So I will put it in that proportion. This is what I will do to find the joint cost for each joint product. So I can have physical units or average unit cost, sales value at split off, sales value after further processing, net realizable value at split off, or estimated cost. Any of these methods I can use for joint cost apportionment. So what are the various methods we have? We can have physical units or average unit cost. So physical units of all joint products, I will add. Sales value at split off, I will multiply with the selling price at split off and apportion on that basis. When I do not have a ready market, I will take sales value after further processing. But sales value after further processing, what's the problem? Value addition post split off is also included. Therefore, I can go for net realizable value. If I don't want to consider the profit, I want only the cost. Estimated profit can be deducted. This is for joint cost apportionment. Which is the best method? If sales value at split off is available, sales value at split off would be the best method. If that is not available, we can go for net realizable value at split off. What is the logic? The logic is that joint cost is the cost incurred at to the split-off stage. Split-off stage or separation stage is the stage at which the products are separately distinguishable. So the value at that stage should be the basis for joint cost apportionment. What gives me the value at that stage? Sales value at split-off. If that is not there, net realizable value at split-off. That would be a proper estimate of what will be the joint cost that is to be apportioned. How will I do? Total joint cost into value as per method, whichever method you are going to choose. Let us say sales value at split-off you are choosing. Then total joint cost into value as per method, which is sales value at split-off for that product, divided by sales value at split-off for all products. Now, you could have a problem where you are given the production quantity, you are also given the sale quantity. Which one should you take? You should take only the production quantity because it is the joint production cost which you are apportioning. Therefore, production quantity should only be taken. Are you clear with this? Okay. Next, to take a decision regarding further processing. What should I do to take a decision regarding further processing? I should see what is the profit I would have generated if I had sold at split-off. What is the profit I will generate if I sell after further processing? I have to look at incrementally what is the cost I have and what is the revenue I have. If my incremental revenue because of other processing is more than the differential cost, then I should choose that. For taking a decision whether a product is to be further processed or not, the method of joint cost apportionment is irrelevant for me. I should take the decision whether to further process or not only based on the incremental revenue and the differential cost. Next, we have service costing. Every method will have some unique feature. Like for example, process costing, the unique feature was that work in progress is there, what should I do? Equivalent production, that concept. In joint products, it was the joint cost apportionment. In service costing, it is the composite cost unit. The composite cost unit means it consists of more than one cost unit. Measuring the cost in a service industry is a complex activity. So I have to take two measurement units. I have to combine them. That is why I have a composite cost unit. You can have passenger kilometer, ton kilometer, bed days, room days, guest days, based on whatever service you are talking about. Now, in service costing, the classification based on variability is an important matter to be considered. So, my plan was to complete the element wise in the first hour and methods of costing in the second hour and devote the last 1 hour to fully the management accounting part, standard costing, marginal costing, and budgetary control. So we are right on time on that. So shall we go to standard costing? As you know, standard costing is an important chapter. Now, there are 4 chapters which you have at the intermediate stage, which are not only important for intermediate, they are also important for final. What are those 4 chapters? Standard costing, marginal costing, budgetary control, and activity-based costing. So in this, first let us look at standard costing. What is standard costing? Standard costing is a technique of costing. It is not a method of costing. Standard costing is a cost control technique. The basic objective of any type of control, I said it is a cost control technique. The basic objective of any type of control, what is it? Actual performance should conform to a predetermined plan. So, for cost control purposes, planned costs are essential. Standard costing is a cost control technique which compares standard costs and revenues with actual results to obtain variances which are used to stimulate improved performance. So standard costs are predetermined costs. They are target costs which should be incurred under efficient operating condition. The standard cost for a product consists of cost for each cost element. So what is standard costing? It is a preparation and use of standard costs, their comparison with actual costs, and analysis of variances as to their causes. Why? Points of incidence. Where? Only if I know why, I can take corrective action. Only when I know where, I can take the corrective action there. So, standard costing is the preparation and use of standard costs, their comparison with actual costs, an analysis of variances as to their causes and points of incidence. Standard costing and variance analysis is done for each cost element. If the standard cost is more than actual cost, it represents a favorable situation. Otherwise, an adverse situation. So standard costing is a control technique that will report variances by comparing actual costs to standard costs so that I can take action. What is the objective of setting standard costs? Stock valuation, fixing selling price. What is the objective of variance analysis? Performance measurement, control. So each cost element I will take and find what is the variance. How will I find the variance? First, let me take material. Material cost is determined by two factors. Any cost for that matter is determined by two factors. One will be the quantity factor, the other will be the rate factor. Material cost is determined by quantity of material consumed in production and price paid for the materials. The difference between standard material cost and actual material cost is material cost variance. Why is this difference happening? Because actual quantity of material used is different from standard quantity for actual production, which is usage variance. Standard price set for material being different from actual price paid, which is given by price variance. Now, let us look into the formulae for this. Now, first let us take a situation where First, let us take a situation where I have only one raw material going into the production. What is material cost variance? Material cost variance is the difference between standard material cost and actual material cost. SP stands for standard price, SQ stands for standard quantity, AQ stands for actual quantity, AP stands for actual price. So SP, SQ is standard material cost, AP, AQ is actual material cost, SP, SQ minus AP, AQ will give me the material cost variance. This material cost variance is made up of two components, usage variance and price variance. SP, SQ minus SP, AQ, SP price is the same. Where is the variance? This is standard quantity, this is actual quantity. Therefore, it is the variance because of quantity used. So, material usage variances, SP, SQ minus SP, AQ. SP, AQ, AP, AQ, 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 actual quantity used is the same. This is SP, this is AP. So, this variance is because of price. Material cost variance is SP, SQ minus AP, AQ. Material usage variance is SP, SQ minus SP, AQ. Material price variance is SP, AQ minus AP, AQ. Supposing there is more than one raw material, I have to further split it. How? Into sub-usage, a part of usage and mix variance. Now, what is RSQ? RSQ is actual quantity put in standard mix. So, RSQ is actual quantity, standard mix. AQ is actual quantity, actual mix. Standard mix, actual mix. The variance is mix variance. SQ is standard quantity, standard mix. RSQ is actual quantity, standard mix. So the variance is in the quantity. This is standard quantity, this is actual quantity. But the mix effect has been removed. So it is a part of usage variance. This is a sub-usage variance, also known as yield variance. So what do we know now? We know that material variance is made up of usage variance and price variance. Similarly, when we go to labor, if material cost is made up of quantity and price, for labor, we are looking at direct labor who are being remunerated on the basis of time. We are looking at variance analysis only for direct labor who are being remunerated on the basis of time. So how do I find? SR is a standard rate. SH is a standard hours. Standard hours for actual production. In respect of material, standard quantity for actual production. This is a standard labor cost. AR actual rate, AH actual hours. So AR, AH is actual wages paid. The difference between standard wages and actual wages is my labor cost variance. Now, when it comes to labor, labor does not have storage value like material. Material has storage value. Therefore, if I buy excess material, I can use it in the next period. But if I engage and pay excess labor and I don't make them work, I cannot use that in the next period. So there is no storage value for labor. Therefore, you will have idle time variance for labor. This SRAH is SRAH worked. This SRAH is paid. If you have paid more hours than what, you have an idle time variance. Idle time variance will always be adverse. Then SRAH paid, ARAH paid, AH paid, no difference in hours. SRAR, the difference is only in rate. Therefore, this is rate variance. So SRSH minus ARAH is labor cost variance. SRSH minus SRAH worked is efficiency variance. SRAH worked minus SRAH paid is idle time variance. SRAH paid minus ARAH paid is labor rate variance. If you have only one category of labor, this is it. But if you have more than one category, skilled, semi-skilled, unskilled, like that, we have to further split it. Like material usage variance, we split into sub-usage and mix. Here also, efficiency variance, we have to split into productivity or sub-efficiency and gang composition. Now, SRSH, SRAH worked. SRSH, SRRSH. What is RSH? RSH is actual hours in your standard composition. This is actual hours, actual composition. This is standard, this is actual hours, standard composition. Actual hours, both are actual hours. Both are actual hours worked. What is the difference? This is put in standard composition, this is an actual composition. So the difference is gang composition variance. Standard hours, standard composition. Actual hours, standard composition. Therefore, this is the part of efficiency variance or productivity variance. So once this is done, are you clear? Material variance, we are looking at material. We are looking at two factors that determine the material cost. One, the quantity used, two, the price paid. So the material cost variance is split into usage variance and price variance. If you have more than one category, we are further splitting it into sub-usage and mix. Similarly, labor variance has three components. If you do not have any difference between actual hours worked and actual hours paid, you are not going to have idle time. If it is there, you will have idle time. So labor hours we are looking at, because we are looking at direct labor being remunerated on the basis of time. So you have efficiency variance. If labor has taken more time, he is less efficient. He has taken less time, he is more efficient. So SRSH minus SRAH is efficiency variance. And SRAH work minus SRAH paid is idle time variance. SRAH paid minus ARAH paid is rate variance. This again, if you have more than one category of labor, say skilled, semi-skilled, unskilled, like that, then you have productivity or sub-efficiency variance and gang composition variance. So if that is done, next we have overheads. Normally, students think that overhead variances are difficult. Not so if we understand clearly. What is it we are going to first see? We are going to see variable overhead cost variance. What is variable overhead cost variance? SR stands for the predetermined overhead rate. AO stands for actual output. SO stands for standard output which labor should have produced in that time. Therefore, when it comes to output, if actual output is more, if the worker has done more within the given time, he is efficient. Therefore, SRAO minus SRSO is efficiency variance. SRSO is the overhead cost which they should have incurred. AOH is the overhead cost they have incurred. So, how much is the expenditure variance we can see? Variable overhead cost variance is SRAO minus AOH. This is when the recovery is based on units. Overheads can be recovered based on units or can be recovered based on hours. If it's based on units, this is how we will have the variance analysis. Next, coming to overheads recovered on the basis of hours. SR, SH. SR stands for the predetermined variable overhead absorption rate per hour. SH stands for standard hours. AH stands for actual hours. AOH stands for actual overhead. SR, SH is the hours they could have taken. AH is the hours they have taken. If the hours they have taken is less, if AH is less, then they are more efficient. Therefore, variable overhead efficiency variances SRSH minus SRAH. SRAH minus AOH is the expenditure variance. Next, we will move on to fixed overhead variances. Fixed overhead variances we have based on units, based on hours. First, let us consider based on units. SRAO. AO is actual output. SR is the predetermined fixed overhead rate. BO is the budgeted output. SRAO minus SRBO. AO, actual output. BO, budgeted output. It is about volume. Therefore, it is volume variance. SRBO is a budgeted overhead. AOH is the actual fixed overhead. The difference between budgeted fixed overhead expenditure and actual fixed overhead expenditure is the expenditure variance. Now, this is the basic variance for fixed overhead. But now, why should there be a difference in the activity level? Fixed overhead, why should there be a difference in the activity level? There can be a, see, fixed overhead is an overhead which is related to a time period. Unlike variable overhead, it does not change with changes in the activity level in that period. Total fixed overhead is constant. It does not change with the change in the activity level. Fixed overhead per unit will keep on changing inversely to changes in activity level. Now, predetermined fixed overhead absorption rate is total budgeted fixed overhead divided by total budgeted volume. By volume, what we mean here is the activity level. Activity level could be measured in terms of units or it could be measured in terms of hours. So the predetermined fixed overhead absorption rate is total budgeted overhead divided by total budgeted volume. Total actual fixed overhead will be incurred. Actual fixed overhead rate per unit will change with the change in actual output. Fixed overhead absorbed. How do I find predetermined fixed overhead absorption rate into actual volume? Now, actual overhead and the standard overhead, that difference is my fixed overhead cost variance. What is my standard fixed overhead? The predetermined rate into actual volume. Predetermined rate, how do I find? Budgeted fixed overhead divided by budgeted volume. Therefore, what is it? I can understand the fixed overhead variance can be because of a variance in volume, or it can be because of a variance in expenditure. The variance between actual volume produced and budgeted volume planned is given by the volume variance. The variance between the budgeted fixed overhead expenditure and the actual fixed overhead expenditure is called the expenditure variance. A variance in volume can be as a result of a variance in one of the following. A variance in workers' efficiency. This is captured in efficiency variance. A variance in capacity utilization of plant and machinery. This is captured in capacity variance. A variance in the number of days worked. This is captured in calendar variance. So what do I know? I know that the volume variance can be split into efficiency variance, capacity variance, and calendar variance. Fixed overhead expenditure variance cannot be split. It is just the expenditure variance. The fixed overhead cost variance can be split into fixed overhead volume variance and fixed overhead expenditure variance. The fixed overhead volume variance can be split into efficiency variance, capacity variance, and calendar variance. Is this clear? So if we split, how do I find the variances? As always, we have to first look at what is the variance when it comes to units. How do I compute the variance when it comes to hours? Both units and hours can be used, and therefore both have to be found. So how do I go about it? Fixed overhead cost variance. SRAO minus SRBO is volume variance. SRBO minus AOH is expenditure variance. SRAO minus AOH is cost variance. This volume variance can be split into efficiency, capacity, calendar. SRAO minus SRSO, efficiency. SRSO minus SRRBO, capacity. SRRBO minus SRBO, calendar. What is RBO? RBO is the output budgeted for the revised number of actual days. So RBO is budgeted output for actual days. BO is budgeted output for budgeted days. SO is standard output, which they should have produced. AO is actual output, which they have produced. This is clear. Once this is done, we can do overhead variances, fixed overhead variances based on hours. What is the difference between units and hours? If it is output, the more the actual, the better, the more efficient. If it is hours, the less time they take, they are more efficient. So, SRSH minus SRAH will be efficiency. SRAH minus RBH will be capacity. SRBH minus SRBH will be calendar. just a swap between standard and actual when it comes to units and hours. So if they ask you to compute all variances, you can have all this information ready, and you will find that I have framed in such a manner, if the result is minus, it's an adverse variance, and if the result is plus, if it is a favorable variance. That is why we have standard first and actual next when it is asked, and actual first and standard next when it is output. So are you comfortable with standard costing? So chapter 13, standard costing is over. Next, let us look at the next chapter, chapter 14, marginal costing. Are you ready? Shall we look at marginal costing? Now, marginal costing, what is it we know? When we look at marginal costing, whenever a company does business, why does it do business? It does business because it wants to generate profit. So they are also interested in knowing what is the minimum they have to sell in order to avoid loss. So, or above which they should sell in order to generate a profit, whichever. Now, let us take three scenarios. What are the three scenarios when you do business? You may have a profit, you may have a loss, you may have a break-even. So, those three situations, let us see. First, sales value, if it is more than cost, you have a profit. So, sales value is equal to total cost plus profit. Sales value is equal to total cost can be split into variable cost plus fixed cost. So variable cost plus fixed cost plus profit. Take variable cost the other side. Sales minus variable cost is equal to fixed cost plus profit. Now, there are assumptions which we have underlying break-even analysis, namely, the variable cost per unit, the selling price per unit remains the same irrespective of the number of units. So these two are directly proportional to the activity level. Then sales minus variable cost, this fixed cost plus profit is known as contribution. Contribution towards what? Contribution towards fixed cost, recovery of fixed cost, and over and above fixed cost which you have will be your profit. So sales minus variable cost is equal to contribution. Contribution is equal to fixed cost plus profit. Profit is equal to contribution minus fixed cost. So when contribution is greater than fixed cost, we end up with a profit. Now, when is it I'll have a loss? When my sales value is less than total cost. So sales value is equal to total cost minus loss. Again, expand it. You will have a situation where loss is fixed cost minus contribution. That is, when contribution is less than fixed cost, it results in a loss. Then, supposing I have a situation where the sales value and total cost are same, then I break even. Meaning what? No profit, no loss. So contribution is equal to fixed cost millions. That is the break-even point. Now, we are interested in analyzing the changes in cost and volume and its effect on profit, for which, as we have already seen, there are certain assumptions which underlie break-even analysis. What are the assumptions that underlie break-even analysis? Selling price per unit is constant. That is, selling price per unit is the same for all activity levels. Cost can be classified into variable cost and fixed cost. Variable cost per unit is the same for all activity levels. Total fixed cost is the same for all activity levels. Mixed cost or semi-variable cost can be segregated into variable and fixed components. In case of a multi-product company, sales mix remains the same even when activity level changes. Now, these are the assumptions underlying break-even analysis. So, based on these assumptions, we can further analyze like this. Contribution per unit is equal to selling price per unit minus variable cost per unit. PV ratio is equal to contribution per unit divided by selling price per unit. Or I can take total also, total contribution divided by total sales value. It just doesn't matter because for total contribution divided by total sales value, I would have multiplied with the number of units, the numerator as well as denominator with the same number of units. So the proportion doesn't change. Variable cost ratio is a complement of PV ratio. If PV ratio is 40%, variable cost ratio is 60%. If PV ratio is 80%, variable cost ratio is 20%, like that. Next, variable cost plus contribution is equal to sales value. So variable cost ratio is equal to variable cost by sales into 100. PV ratio is equal to contribution by sales into 100. So as I was telling you, PV ratio can be found as 100 minus variable cost ratio, or variable cost ratio can be found as 100 minus PV ratio. Break-even point in units. How do I find? Fixed cost divided by contribution per unit. If I want it in value, I can multiply the break-even point in units into selling price, or I can divide the fixed cost by PV ratio. Now, sales is made up of two components. What are they? Break-even sales plus margin of safety. Sales is made up of break-even sales plus margin of safety. What is margin of safety? Over and above break-even sales, whatever you have is the margin of safety. What does it mean? Even if you fall, the safety net is there to protect you from incurring a loss. Contribution, I know, is equal to fixed cost plus profit. Sales is equal to break-even sales plus margin of safety. Contribution is equal to fixed cost plus profit. Now, I can analyze this in different ways. Sales into PV ratio is equal to contribution. Break-even sales into PV ratio is equal to fixed cost. Margin of safety into PV ratio is equal to profit. Sales is equal to break-even sales plus margin of safety. Contribution is equal to fixed cost by profit. So, from this itself, I can see PV ratio is equal to contribution by sales. PV ratio is equal to fixed cost by break-even sales. PV ratio is equal to profit by margin of safety. I can analyze like that. Sales into PV ratio is equal to contribution. Sales is equal to contribution by PV ratio. PV ratio is equal to contribution by sales. Break-even sales into PV ratio is equal to fixed cost. So break-even sales is equal to fixed cost by PV ratio, and PV ratio is equal to fixed cost by break-even sales. Margin of safety into PV ratio is equal to profit. So margin of safety is equal to profit by PV ratio, or PV ratio is equal to profit by margin of safety. Is this clear? Then variable cost per unit will be change in total cost divided by change in sales units. I know fixed cost does not change with change in activity level. So the cost that changes will be only the variable cost. For how many units it has changed, if I say variable cost per unit, I can find. Similarly, variable cost ratio, change in total cost divided by change in sales value. Contribution per unit can also be found as change in profit by change in units or change in contribution by change in units. Is it clear? So, what is the first type of problem which you will get where they ask you to find out what is a break-even point? Now, you have what is known as multi-product break-even point. What we have discussed just now is only one product is the single product break-even point. What about multi-product break-even point? Multi-product break-even point, we saw one of the assumptions that in a multi-product situation, the sales mix remains the same. Therefore, in a multi-product break-even point, we will try to establish the combined or weighted average contribution per unit. So how will you find combined break-even point? Total fixed cost divided by combined contribution per unit. Combined contribution per unit, weighted average contribution per unit means total contribution divided by total units. Multi-product break-even analysis, combined break-even point in units is equal to total fixed cost divided by combined contribution per unit. How will you find combined? Take the total contribution, divide by the total number of units. Or contribution of each unit you take, each product you take, multiply with the number of units. Or multiply the sale quantity ratio, whichever way. You do this and then total. Then also you will get combined break-even point. The only difference between break-even point and value is that instead of contribution per unit, you will take PV ratio. Whenever you want something in units, you will take contribution per unit. When you want in value, you will take PV ratio. So this is the second category of problem which might be asked in this chapter, marginal costing. What is the third category? What is known as point of indifference? Shutdown point. That could be asked. What is it we will do with point of indifference? Point of cost indifference is equal to difference in total cost divided by difference in variable cost per unit. Point of cost indifference is equal to difference in total fixed cost divided by difference in variable cost per unit. When will you find point of cost indifference? When, let us say, you are interested in purchasing 2 machines. Capacity, everything same, but the variable cost for one is different and the fixed cost for the other is more. If you are considering 2 machines, of the 2 machines, one machine has the lower fixed cost. It also has the lower variable cost. No problem in taking the decision. But we'll have a situation where of the two machines, first machine will have more fixed cost, but less variable cost. Then what should I do? That is when you will find point of cost and difference. Difference in total fixed cost divided by difference in variable cost per unit. Above the point of indifference, you will choose that which has a lower variable cost. Below the point of indifference, you will choose that which has a lower fixed cost. For any activity level below the point of cost indifference, the machine with the lower fixed cost is better. Then point of profit and difference, also known as shutdown point. How will I find difference in total fixed cost divided by difference in contribution per unit or difference in variable cost per unit? Again, same string. This is called the shutdown point. That is, temporarily you have a slackened demand. What will you do? Will you shut down or will you operate? That kind of a decision. For any activity level below the point of profit indifference, the alternative with lower fixed cost is better. At levels below the point of indifference, it is better because the additional contribution is not sufficient to recover the additional fixed cost. For any activity level above the point of profit indifference, alternative with higher contribution per unit is better. So this is the next type of problem. First, we saw single product BEP how to find. Next, we saw multi-product BEP how to find. Then we saw point of profit or cost and difference. Then you have what is known as optimal mix. Optimal mix, you have different situations. What is the meaning of optimal mix? What is the meaning of product mix optimization? Product mix means the combination of products that an organization offers. That is, what products and in what quantity. An optimal product mix is one that results in maximum profit for the organization after taking into consideration the supply and demand constraints. The level of activity will be decided based on production and sales, based on supply and demand. Supply side, I require resources like raw material, labor availability, machine availability. This will place the restriction on the maximum I can produce. Market side demand may have two restrictions. One, the maximum quantity that will be demanded. Two, the minimum contracted quantity. So let us look at it under different situations. First, what is the situation I'm contemplating? When it comes to supply, again, based on resource availability, I could have a situation when there are no resource constraints. Then I will rank the products based on contribution per unit. I could have a situation when there is only one resource constraint. Then I can rank the products based on contribution per unit of the limited resource. I can have a situation when there is more than one resource constraint, and those things can be solved using quantitative techniques like linear programming and all. So from the point of view of market demand, what happens? When only maximum demand is specified, what should I do? I should rank the products first. After ranking the products, I should assign the limited resource to the products in the order of ranking to the extent of maximum demand. This is situation one. Only minimum demand is specified. What will I do? I'll rank the products. Assign limited resource to all products to satisfy the minimum demand except the first rank product, because entire balance resource can be given to the first rank product. So systematically I should approach. What is the situation from the supply side? Is there no resource limitation? Is there one resource limitation? I should see. Then I should look at what is the situation from the demand side. Is it minimum demand only? Maximum demand only? Or situation 3, both minimum and maximum demand? So when both minimum and maximum demand are specified, what should I do? As always, first step, rank the products. Assign limited resource to all the products to the extent of minimum demand. Balance resource, balance demand. Balance resource will be assigned to balance demand and the order of ranking. Is this clear? Have you understood? Are you clear? So we will decide on what is the optimal mix based on the situation. What situation? From the supply side, from the demand side. From the supply side, what? No resource constraint or one resource constraint. No resource constraint means ranking on the basis of contribution per unit. One resource constraint means ranking based on contribution per unit of the limited resource. Then demand side, maximum demand only, minimum demand only, or both maximum and minimum. Accordingly, we will decide. Is it clear? Have you understood? So this is optimal mix. So your problems, you could have, first, you could have break-even point. Then you could look at multi-product break-even point. Then you could look at point of indifference. It could be cost indifference. It could be profit indifference. Then you could have optimal mix. Then, of course, we need to know the difference between marginal and absorption. What is the difference? There are a lot of similarities. There is just one difference. What is the difference with regard to fixed production overhead? That is, when is it treated as a product cost? When is it treated as a period cost? So the item of cost, if I say, I have direct material, direct labor, variable production overhead, all these are considered as product cost. I have non-production overhead, administration, selling, under both absorption and marginal, they are considered as period cost. Fixed production overhead is the area of difference. And absorption, it is product cost, and marginal, it is period cost. Is this clear? So, what are the various types of problems you could get under marginal costing? Under marginal costing, they could ask you for single product break-even point. They could ask you multi-product. They could ask you point of indifference. They could ask you optimal mix, or they could ask you marginal versus absorption. So only when you have stock, there will be a difference between profit shown as per marginal costing and profit shown as per absorption costing. If there is no stock, There is no difference. Then lastly, it is chapter 15, budgetary control. In budgetary control, what types of problems can you get? You can get production budget, sales budget, material consumption budget, material usage budget, like that. Functional budgets you could get. Or they could ask you flexible budget, or they could ask you cash budget. So in flexible budget, then classification on the basis of variability, fixed cost, variable cost, semi-variable cost. That is what is important. Mostly they will ask you functional budget. How will you go about doing a functional budget? Functional budget, that is looking at what is the sales. For this sales, adjusting for production, what will be the production quantity? And based on this production, what will be the material consumption? Based on material consumption, what will be the purchase? Like that, we need to look at. How will we do? You will find production by taking sales, adding closing stock, deducting opening stock, and arrive at production. Then production you will take. Any loss, anything is there, you will adjust and arrive at purchase. So the order, the sequences, sales budget first, next production, then material consumption, then material purchases. Then based on production, labor requirement, manpower budget. Like that, in that sequence, you will prepare. Is this clear? So I think with regard to budgets, you should not have much of a difficulty because, as I told you, logical sequence we have to follow. What is the production will be based on what is the sales. And my production will decide on the material consumption. Material consumption adjusted for stock will tell me what is the purchase. So if you want to know how to present such a problem, see production budget. What will I do? It's a budget. So obviously for the forthcoming year, for the next year, sales units for the next year, how much I will take. I will add the closing stock because I have to produce for my sales. I also have to produce for the stock which I want to hold. So totally how much? But if I already have opening stock, to that extent I need not manufacture. I will deduct it. This will result in my production units. Then come to consumption. Production is about finished products. Consumption is about raw material. So for my finished product, what is the raw material requirement? For each one, how much is required? I will see. Then I will find consumption. Based on consumption, I will have purchases. I will adjust the stock of raw material to arrive at purchases. So this is how I'll go about. So if you have any queries, you could post on YouTube. And I think your coordinator, the host, will let me know whether there are some queries. And we were able to cover the entire syllabus in 3 hours, or a little less than 3 hours, another 5-6 minutes to go. And all the 15 chapters, we have had a rapid recall. This is called a rapid recall. Now, once again, let's just look at whether whatever we planned, whatever was the agenda, we covered or not. What is it we planned at the beginning of the session? At the beginning of the session, we said we will look at the question paper pattern. Did we? Yes, of course we did. Did we look at the chapters, which are all the problem chapters, which are all the theory chapters? We saw that also. And then, as I told you, I grouped the chapters in some logical classification. This is what we said we will plan. So what did we do? Did we do the question paper pattern? Yes, we did. Time management, did I guide you? Yes. So problem chapters, I grouped into cost elements, where we revised these chapters: materials, employee cost, overheads, activity-based costing. Then that which has a functional format, your cost sheet, cost accounting system, unit costing. Then specific order, we discussed about contract costing. In continuous operation, we discussed process costing and joint products, byproducts in detail, and service costing we touched upon. And then, of course, standard costing, marginal costing we discussed in detail. Marginal costing, various type of problems also we discussed. And budgetary control, I just touched upon the elements. As I told you, 4 of these chapters, activity-based costing, standard costing, marginal costing, and budgetary control, will be useful for final also. And Nitish will vouch for it. He is a final student. So these 4 chapters are there in final also, in your SEMPE, Strategic Cost Management and Performance Evaluation.
A bit advanced level, I think that's fine.
Yeah, of course, much advanced level. Otherwise, it will not be final, right?
Yes.
You cannot have the same thing as inter. Of course, final you will have. In fact, CMPE is more like a case study based approach.
Much more intricacies will be involved in that.
Yes. So I think we were able to make proper use of the 3 hours which was assigned for this. And that brings us to the end of the session.
It was very great hearing from you. So the entire curriculum was fragmented in a very student-friendly manner. So it was very great. It will be very greatly helpful to the students in adapting their forthcoming examinations. So it's time to see the queries from our beloved friends. So Vanati has one query where, so she has a query that where overhead distribution is to be done. In what basis it is to be done, the cases where it overhead distribution is to be done.
I think what it means is the apportionment. Apportionment, as we have seen, it has to be equitable, not equal. So based on, you have various bases of apportionment based on for what that is used. For example, rent means floor space. And if it is machinery depreciation, then it will be machinery value. If we are talking about power, it will be horsepower as well as machine hours. So it's an equitable distribution based on the resource utilization by the various cost centers or your departments, your production department and service department. Yes, I left the last few minutes for queries only. Is there any other query?
We have one more query from the same person, ma'am.
Yes.
Whether a predetermined absorption rate is the budgeted rate. So she has a doubt whether predetermined absorption rate is the budgeted rate.
Correct. Predetermined, she is right. Predetermined absorption rate. Any rate, you have 2 factors, the cost in the numerator and the activity level in the denominator. The predetermined or budgeted cost in the numerator, and the activity also budgeted in the denominator is a predetermined rate. So both are predetermined. Whereas when you talk about overhead absorbed, the rate which is predetermined is applied on the actual activity. That will be the overhead absorbed. So anything else is there?
Yeah, that's it. That brings us to the end of the session.
Okay.
So it was a very great session. It was a very wonderful session actually. So benefiting enormous students. So who are at their verge of preparation. A very few days left. Hardly 2 weeks.
That's right. This kind of a rapid recall and revision helps them. So I take this opportunity to wish the students all the best. I'm sure they'll all come out with flying colors. So I enjoyed the session. I hope you find the session useful. Bye. All the best.
Yeah.